In this presentation, we will continue on with our example problem related to a not-for-profit organization. This time, we will be entering the closing entries, those entries that are done at the end of the time period, those entries that will be closing out the temporary accounts, typically considered the income statement accounts, or most of them being the income statement accounts. Here, the statement of activities accounts. Here's going to be our information. We have on the right side, we have our trial balance. The green accounts are going to be the asset accounts. The orange accounts are going to be the liability accounts. Then we have the net assets. That is what would be the equity section in a for-profit type of organization. Here, net assets section. Note that the net assets section is broken out between net assets with donor restrictions and those without donor restrictions, and further broken out to the ones with donor restrictions by program and by permanent endowment. That's going to be one of the new things that we will have to deal with. We will deal with it here as we go through the closing process. Below that, then we have what would be the income type of accounts, the income and expenses in a for-profit type of organization, similar to as what we have here. We have income and expenses in essence. However, the income is going to be something like the contributions being what would be similar to income in a for-profit organization. Contributions you can see also broken out between categorizations of with donor restrictions and those without donor restrictions. So we have that further categorization here, that categorization being labeled within the accounts. And then, of course, we have our expenses, and here we have the expenses broken out by function, commission, the expenses by function, including the exhibition program, the community education, the management and general, and the fundraising. What we're going to do here is we're going to be closing out these items in a for-profit type of organization. You would typically think of closing out all of these blue accounts, and that's what we'll do here. At the end of this, we're going to end up with a post-closing trial balance. That will be that all of these blue accounts, or the dark blue accounts, the temporary accounts, what would be similar to the income statement accounts, will be zero, and we will have closed them out to the net assets, allocating them appropriately to the proper net asset account. Same process here that we're going to do for the not-for-profit organization. However, of course, we have to deal with the with and without donor restriction issue as we go through this closing process. In a for-profit organization, you may recall that some people learn like a 4-step closing process in the for-profit organization. First, closing out revenue type accounts to an income summary account, which is a temporary account, then closing expenses to the income summary, then closing the income summary out to either retained earnings or to capital, depending on if it's a corporation or if it's a sole proprietor. And then finally, we would close out any draws if it was a sole proprietorship or a partnership to the capital account, or we would close out any dividends for a corporation to the retained earnings account. Here, we're not going to be doing a 4-step type process. We're going to be doing more of a one-step process, similar to what you could do in a for-profit type of organization. Instead of doing those 4 steps, in other words, you could basically close out the entire income statement, revenue and expenses, directly to retained earnings or capital if you so choose. We're going to do a similar process here to that 1-step process, closing out expenses and revenue in the same journal entry. However, we will have multiple journal entries, not by closing out revenue first and then expenses, but by closing out the ones without restrictions, then the ones with restrictions. So the first journal entry we will then be doing is closing out the items that do not have restrictions. Our goal here, just like with any closing process, once again, close out all of the dark blue accounts. So we'll start off here with the contributions without donor restrictions. It's got the 44,121 in it, so we're just going to do the opposite thing to it. It's a debit over here. We're going to go ahead and credit it to make it go down. I'm going to skip down here to the investment income without donor restrictions, also kind of like an incomes type of account, has a credit balance. We are then going to, of course, debit it to make it go down. Then we've got the membership dues. Membership dues at the 16,785. It has a credit as well because it's an income kind of account or similar to. We are going to debit it to make it go down. Then we have the tuition and fees. Tuition and fees at the 7,084 has a credit balance here. We're going to do the opposite thing to it, debiting it to make it go down. Then we've got the commission revenue. So the commission revenue at the 2,448. That's also kind of revenue account. It has a credit balance. We will be doing the opposite thing to it to make it go down. Then we have the expense kind of related accounts. We have the 22,366 in exhibition expense. It has a debit. Therefore, we're going to do the opposite thing to it, crediting the exhibition expense to make it go down to 0. We then have the community education. It has a debit in it. We are going to credit it to make it go down. Then we have the management and general. It has a debit. We're going to credit it to make it go down. Then we have the fundraising items. It's a debit. We're going to credit it to make it go down. So that's where we're going to stop with this first journal entry. Note what we're not picking up here. We haven't picked up the investment income with donor restrictions, and we haven't picked up these two items down here, the net assets, and we'll talk about those. Those are going to be something we will do in following journal entries. Then, of course, the debits minus the credits. If we were to add this up, we can say, well, okay, the debits are 44121 plus the 688 plus the 16785 plus the 7084 plus the 2446 minus the credits of 22366 minus the 23311 minus 18638 minus the 11183. We get the 4,371. We got the 4,374. It's rounded here. It's because there's pennies involved. So we're going to have the 4,373. And that will be our plug kind of answer. We need a debit for it. We're going to put that into the net assets without donor restrictions. So that's going to go to the net assets without donor restrictions. Posting this out then, it does what we would expect it to do. These accounts are going to be going down to 0, right? Because that's our objective. The post-closing trial balance, we've decreased all the revenue accounts down to 0. We've decreased the expense accounts down to 0. We've put the difference then into the net assets without donor restrictions, it being a decrease as well, given the fact that we had a loss. You'll note we had a loss here. That means that the obviously the credits were less than the debits, or revenue was less than the expenses. We have, in essence, a loss, and that loss is going to be allocated to the net assets. We haven't closed everything out yet. That's why this loss doesn't match this number, because we haven't closed out this account yet. So we have the 4,373. It's a debit. We know that the net assets, like equity, is a credit balance account. When we debit it, it will then be going down because of, in this case, it being a loss. Next, we're going to have the next transaction, which is going to be closing out the items with donor restrictions. So you'll note what's left here. We got obviously this one left. We got these two left. We're going to be dealing with this one now. That's the investment income with donor restrictions. We're going to be closing that one out. It has a credit balance in it. Therefore, we will be debiting it, investment income with donor restrictions. We will then credit the net assets with donor restrictions. If we post that out, this is what it will look like. Investment income has a credit balance. We are then debiting it, making it go down to 0. Then we have up top, we have the net assets with donor restrictions having a credit balance. This one is increasing it because we're closing out a revenue account to it. So it's going to be going up in the credit direction to that 15,748. This puts us back in balance, debits equaling the credits. Now we're only left with these two that we have to deal with. We'll deal with them in two separate transactions. Next transaction, you'll recall that these two accounts are those accounts that are transferring from something that has a restriction to something that does not have a restriction. So that means that if you read these accounts, these very long accounts, it might be easier to read over here. Net assets released, satisfaction of purpose restriction without donor restrictions. And then the other account is going to be one with donor restrictions. Same name, with donor restrictions. You'll recall the one without donor restrictions is always, we're going to consider going up in the credit direction, because we're always going to be taking something that was once restricted and now unrestricting it, moving it from the one with restriction to the one without, increasing the one without. I would consider it something like a revenue account, because revenue accounts have a credit balance. This one you're considering then going up in the credit direction. This one you can kind of consider going down, even though it's always going to have a debit balance. But you can kind of think of it going down or decreasing net income with the debit side of things. So we're going to close these out, and we're going to close them out just as we would, just like you would think. This is the one without donor restrictions. This is the one with restrictions. That's the key term. We're going to be closing them out due to like net assets account, the one with restrictions and the one without restrictions. So we'll close the one without restrictions first out to the net assets without restrictions. We see here that we have a credit balance, and therefore we're going to do the opposite thing to close it. So we have a credit balance here. We will then debit it to close it out. Then we're going to credit the net assets without donor restrictions to close this out. So here we go. We're going to be closing this out. We post this. It's going to bring down the balance to 0. And then we have the net assets without the restrictions up top. Net assets without restrictions, we're going to be crediting it, increasing it in the credit direction. Next and finally, we have this last remaining item that we need to be allocating out. It's going to be the net assets release satisfaction of purpose restriction with donor restrictions. It has a debit balance. We need to do the opposite thing to make it go down. Therefore, we put it on the bottom. We will be crediting it in our final closing entry. Then we're going to be posting it to, or recording it to, or recording it to the net asset account of the net assets with donor restrictions, so the like net asset account. So if we post this out, then we see that the net assets released is going to be a credit, so it's a debit balance. We're going to be crediting it to make it go down to 0. That's going to be this item. The other side going to the net assets with donor restrictions. Here's the net assets with restrictions. We have the 15,784. It's a credit. We're going to be debiting it to make it go down. So this is going to be our post-closing trial balance. You'll note that in the post-closing trial balance, we only have the assets, liabilities, and what would be similar to the equity section, the net assets section at this point in time. All temporary accounts have now been closed out. If we consider the assets, liabilities, we note that if we add up the assets and liabilities, the 4229 plus the 9811 plus the 5960 plus the 960 plus the 12800 minus the 4308 plus the 5887 minus the liabilities of the 2926 minus the 6020 adds up to 26,393. That should be equivalent to the equity. Assets minus liabilities should be equal to what would be equity or net assets. I'm going to subtract out these three, see if we get to 0, minus the 8558. Minus the 11948 minus the 5887, and that brings us down to 0. So just note that assets minus liabilities is going to equal what would be equity, the net assets. Before we had closed everything out, all of these blue accounts, if we added up the debits and credits, would equal the sum of these three accounts we have here.